An important consideration when accountants are dealing with the inventory account, which, as you know, is a current asset that goes onto the balance sheet, is which physical goods should be included in inventory. As you know, all companies are required to do a physical inventory count at the end of the year. That count is for whatever is in the warehouse or on the premises of the company, but there are two additional considerations in the form of goods in transit and consignment goods. Goods in transit are those goods which may be shipped to or from the company, and at year end they are still on a truck or on a ship or some other form of transportation. And consignment goods we'll discuss a little bit more, but they relate to an ownership issue, which is more easily explained in an example. So let's look at some of the theory behind this. So the rules will help us to determine whether inventory belongs to the company or not. So even though it may be a little bit dry to go through all the rules and it feels a little bit boring, the reality is that your level of frustration will be much lower if you understand the rules so that you'll be able to answer the questions more easily. So for goods in transit, we have to be concerned with shipping terms. There are two options for shipping terms. The first one, free on board shipping point or FOB shipping point, and the second one, FOB destination. These names tell us something about who owns the inventory while it is in transit, in other words, while it is being shipped. And this is important for us because we want to know whether this inventory belongs to the company or not, so that we can check whether the inventory has been correctly included or excluded. Since inventory is an asset, sometimes companies want their inventory number to be as high as possible, and it's easy for confusion and errors to arise, or even worse, that fraud may take place, and especially with shipping terms, which are easy to manipulate. So we have to be very careful that we understand how the shipping terms work, so that we'll be able to figure out whether the inventory number is accurate or not. So the first thing, FOB shipping point, here the buyer owns the inventory during transit because ownership passes from the seller to the buyer at the shipping point. So goods in transit shipped FOB shipping point but not received at year end belong to the buyer. Now remember, our company may be the buyer or the seller. So not only do we have to ask what are the shipping terms, we would say FOB shipping point, then we have to ask who owns the stuff in transit, and we would know that it's the buyer. Then we have to ask, are we the buyer? Right? Because if we are, this inventory has to be included in the inventory of the buyer. So another way to think of it also, if you remember that FOB shipping point, the buyer pays for inventory, so the buyer also owns the inventory in transit. The buyer pays for shipping, and owns the inventory in transit too. Either way you think of it, when it's FOB shipping point, the buyer owns the inventory in transit. With FOB destination, it's slightly different. The seller owns the inventory in transit because ownership passes from the seller to the buyer at the destination. And by destination, we mean the place of the buyer's business or location. So if you buy from Amazon, the destination is your home. So if things are shipped FOB destination, then Amazon owns that item until it reaches your home. So goods in transit shipped FOB destination but not received at year end belong to the seller. So that would be included in the inventory of the seller. The seller pays for shipping and owns the inventory in transit too. So if you recall that with FOB destination, the seller pays for shipping, you can remember in that way that the inventory therefore also belongs to the seller. So you may notice that there is some either memorization or some technique that you will have to use to remember that when we have terms FOB shipping point, the buyer owns the inventory in transit, and when we have terms FOB destination, the seller owns the inventory in transit. For consignment goods, the scenario is that inventory is sent by the consignor to the consignee. I'll give you an example of how that works because these words are a little bit strange. The inventory therefore belongs to the consignor even though it is located at the premises of the consignee. So before we get to this algae example, I'll give you another one. If you think of a consignment store where maybe someone takes their prom dress or their wedding dress, basically what happens is the dress gets given given to the consignment store. The consignment store says, I'll hang it on this rack for 3 months. If it's sold within 3 months, you get 80%, I get 20%. And then if it's not sold after 3 months, you have to come back and pick it up. So basically, the dress belongs to whoever brought it in. So let's say I brought in my wedding dress. The dress would still belong to me until it gets sold to a customer. If it doesn't get sold to a customer, it gets returned to me after 3 months. Similarly with companies, if LG sends tablets on consignment to B&H, then the tablets belong to LG and not to B&H until they are sold. And if they're not sold, then B&H will have to return them to LG. The tablets should therefore be included in the inventory count of LG. So the easiest way to think about this is that the inventory will always belong to whoever sent it away. So LG will be the owner of the inventory, even though the inventory is located at B&H. So let's look at an example to see if we can further demystify these concepts. So I'm looking at example 2 of the practice problems, and this is on page 12 of your handout. Example 2 of the practice problems, page 12 of your handout. It's based on the textbook example. So the instructions say that based on the above information, calculate the amount that should appear on Ali's balance sheet at December 31st, 2012 for inventory. So this company is dealing with a year-end inventory count, and probably there are some considerations as it relates to goods in transit and consignment goods. So let's look here. In your audit of Ali company, you find that a physical inventory on December 31st, 2012 showed merchandise, which means inventory, with a cost of $200,000 was on hand at that date. So they've given you a dollar amount. You also discover the following items were all, and this is very important, excluded from the $200,000. So anything that is listed here in items 1 through 5 was not included in the $200,000. So it's up to us to figure out whether these amounts should be included or whether they were correctly excluded from the $200,000. So go ahead and find a clean page or something that you can write in, and let's work through this problem together. So we want to come up with a dollar amount that should appear on the balance sheet. So let's start with what we know. There was a physical count, and as a result of that physical count, we know that there's an inventory balance of $200,000. And so now we'll go through each of these items to see whether they are applying to the number, whether they should be added or whether they were correctly excluded. So in number 1, there's merchandise of $20,000, which is held by Ali on consignment. The consignor is the Max Suzuki company. So let's go back to our theory about consignment goods. Inventory is sent by the consignor to the consignee. The inventory belongs to the consignor, which in this case is Max Suzuki. So even though Ali has the stuff on consignment, it belongs to Max Suzuki. Therefore, Ali correctly excluded this inventory from its count. So we don't need to do anything. So we'll put 0 here, and in brackets we can say correctly excluded because it belongs to Max Suzuki. So let's look at number 2. Merchandise costing $25,000, which was shipped by Ali. So if it's shipped by Ali, it must mean that Ali was the seller. FOB destination to a customer on December 31st, 2012. The customer was expected to receive the merchandise on January 6th. This means that at year end, December 31st, the customer had not yet received the merchandise. It was in transit. So FOB destination is the terminology used here. So let's go in and see in our FOB rules who owns the stuff. So when inventory is shipped FOB destination, Goods in transit but not received by the buyer at year end belong to the seller. So this inventory belongs to the seller. So let's go back. Merchandise costing 25,000 which was shipped by Ali. So because it was shipped by Ali to a customer, Ali is the seller. FOB destination, the seller owns the goods in transit, which means that Ali actually owns these goods at December 31st, 2012. But remember, these goods were excluded from the 200,000. So this is an error. These goods should have been included in the 200,000 because the terminology here or the shipping terms is FOB destination. So what I need to do is add the 25,000 into my inventory balance, and this is include because belongs to Ali. So we already managed to find one error. Number 3, merchandise costing 23,000 which was shipped by Ali. So once again, Ali is the seller. FOB shipping point to a customer on December 29th, 2012. The customers were scheduled to receive the merchandise on January 2nd. So this part of the transaction or the sentence is telling us that the goods would be in transit at December 31st, which means we have to figure out who owns them in case they're supposed to be included in Ali's inventory. So the terms are FOB shipping point. So if we go back to our theory, we know that with FOB shipping point, the goods belong to the buyer while they are in transit. So the question now is whether Ali is the buyer, but we know that Ali is actually the seller because of the words shipped by. So therefore, these goods were correctly excluded. Remember, everything in this row was excluded, and so we know that this was correctly excluded. So I'm going to do the same thing as number 1. I'm going to put a 0. We don't need to add anything in. Correctly excluded, but not belongs to Max Suzuki, belongs to the customer. Okay, the buyer. For number 4, merchandise costing 60,000 shipped by a vendor and received by Ali. Okay, so Ali is the buyer. So merchandise costing 60,000 shipped by a vendor FOB destination on December 30th, 2012 and received by Ali on January 4th, 2013. So Ali is the buyer and the terms are FOB destination. So let's go back to our theory and check who owns it. FOB destination, the inventory belongs to the seller and Ali is the buyer. So therefore this inventory does not belong to Ali, it belongs to the seller. So we don't need to include it, and we will actually also say 0 correctly excluded because it belongs to the seller. It doesn't tell us the name of the seller, so we will just call it seller. The last one, number 5, merchandise costing 42,000 shipped by a vendor. So again, shipped by a vendor is telling us that Ali is the buyer. FOB shipping point on December 31st, 2012 and received by Ali on January 5th, 2013. So when we look at FOB shipping point over here, we have to go back to our theory and see, okay, FOB shipping point, the goods in transit belong to the buyer. Are we the buyer? Yes, we are, which means that these goods should have been included in Ali's inventory at December 31st. Although they had not yet reached Ali at December 31st, they belong to Ali because with FOB shipping point, the goods in transit belong to the buyer and Ali is the buyer. So we found another error because the 42,000 worth of goods should have been included. Right? We include it because it belongs to Ali based on the terms. So in order to answer our question, we actually have to go and sum everything that's here, and we find out that the inventory balance should have been 267,000 at year end instead of the 200,000 that was shown. So actually the assets of this company are understated if we had left it at the number that it was before. But because we went through and found some of these errors, we were able to correct it, and now the company actually has $67,000 more of current assets. Now you might say, well, 67,000, is that really a big deal? Well, it actually is, because we started with an inventory a number of 200,000, and 67,000 is actually a material amount in light of the previous inventory balance. So this concludes our discussion on goods in transit and consignment goods. You have some help now based on this example, and also some of the theory to be able to attempt a similar question in your pack.